Most traders spend years chasing the perfect strategy, burning through countless ideas that never pan out. In this conversation, we're breaking down how experienced traders actually approach strategy research. We're going to be primarily focusing on how to find fresh new trading ideas and then also briefly talking about how to test them systematically. Pedmo and I will share our real world approach to developing trading strategies, including how you should collect, evaluate, and even filter out potential ideas before they become a live trading idea. We'll also touch on some intriguing questions and topics as the conversation flows. But let's get straight into this episode. My first topic for today is a question I get asked a lot in the DMs and also on Twitter threads, is how do you always come up with new ideas? Now, I'm going to move this over straight to Pedma because I think Pedma is always exploring new ideas. He always brings me cool things to look into. I try to as well. But how do you go about it, Pedma?
Yeah, sometimes too much, but the way I do it is very simple. So I'm a lot on Twitter, for example, and okay, let's start with different tiers here. So if you are very new to if you are trying to build a book of strategies that you want to trade, you don't have much experience doing that, I would recommend you start with something like start reading old papers, things that are like boring, but that they are very known, like stuff like risk premium on trend following, momentum, strategies like that we know those effects last, and many people still trade them to this day, and try to implement those ideas you find in those papers. So that is the first thing I would do, because those older papers, even though they are a bit, it's not like you are going to find like a gold digging strategy, like something that is going to make you rich, but you start testing new ideas. So I would start at papers. Then I would go to blogs and social media, YouTube, stuff like that, because you can find other people that trade and that have different ideas, and you can test those ideas. There you need a little bit more of intuition, because not everyone that you'll find has good ideas because they don't actually trade. So it's a little bit around experience as well. But once you gain some experience in reading those papers, testing the ideas, you start getting an intuition of what might work. And okay, then you have another step that you can start implementing. And when you are adding all of these ideas, start adding them to a database, because you won't have time to study them all, right? And you don't want to lose them as well when you're doing your research. So you start doing a bank of ideas, and for example, you go on Twitter when you have a little bit more experience and you see someone talking about a yield strategy that you see here on crypto, for example. And okay, you take a screenshot of that tweet and you save it on a folder for a future research project that you make. And you start over time, like the weeks go by, you find new ideas, new research papers, new blogs, stuff like that you find, and you find yourself with a database of a bunch of ideas that you can never, like, you almost can never get through because it's so much research. And that's how you build your own bank of ideas. How do you do it, Munir?
Gotta say, you have quite a well structured approach to it. I don't think I'm as well structured to it nowadays, but I definitely agree. You always want to keep track of all your ideas that you come across. I will say, papers for me have been more of a, I guess, recent addition. I didn't ever really start with papers. I'd say for me, the main places I've always got ideas was either Twitter. I think Twitter is an amazing resource. There's a lot of junk as well, but there's a lot of decent ideas as well. And then I'd say books were very highly rated. And I'd say probably last would be probably YouTube. There's a couple good ideas here and there on YouTube, but they're a lot harder to find compared to at least Twitter, or maybe I just use Twitter a bit more often. And then for actually how I think about strategy ideas, I really like how David Austin does it. So he's the guy that wrote Evidence-Based Technical Analysis. Now, his book is not perfect. There's still flaws in it. But he gave me one of my key ideas, is that you always come across a strategy based on strategy type. So what are you trying to accomplish? Is it an arbitrage? Is it a trend following? Is it a mean reversion? I always come across it on there, because one thing I see often with many people's strategies is they come across it as a way to solve every issue with a strategy in one particular strategy. So let me just expand upon that in a second, is that when someone has a trend following strategy, let's say, but they don't understand that they actually have a trend following strategy, they're going to try and make it work during mean reversion times as well. They will often not just accept the fact that, hey, it's a trend following strategy, it's not going to perform very well in ranging markets. They'll try and add 5 extra parameters to make sure that it either avoids them completely or it, can somehow trade really well during a 5-minute range, which is just not a natural way to do it. And that just often causes either data mining bias or overfitting. So ultimately you have a very pretty backtest, but you try that on live, it's just going to completely flop and you're not actually going to get anywhere. So when I'm thinking about ideas, I'm always just thinking, is this trend following? Is this mean reversion? What am I trying to optimize for? What is the normal behavior of this particular strategy? Now, obviously that takes time, but that's where I think, at least for me, I've got the most, edge, at least in my strategy kind of research. What, do you agree with that? Do you kind of think in strategy types as well?
Yeah, for sure. You want to separate everything into different buckets of what you're trying to harvest from the market. And I would even say that when you are starting out, that you should focus on one specific thing, or one or like between 1 and 3, let's say, things like types of strategies, and see what fits you best, what you can manage and stuff like that. So definitely, and I would store them in the database that we said, like your database of research. You should store them differently, put them tags on them and say, okay, this should be a momentum effect, this should be a mean reversion, whatever, so that you can test different ideas and you know what you're doing. But finding new ideas and strategies is all about that. It's like during the day, whatever, when you are walking, stuff like that, you get an idea, you pick up your phone and you put it on your database and then you test it. But you have to make it regular, like any other job, right? It's your job to research, it's your job. Your job is like, when you are doing this very professionally, your job is not to trade. You are not going to be trading a lot. You don't have that much edge usually. And when you do, you usually want to automate stuff that is higher frequency, right? Even if you're trading like 1 hour or 4-hour bars or whatever. So your job is really to be a researcher and to try always to innovate your edge. And the job of a researcher most of the time is always just finding new ideas, and ideas come out everywhere and you need to keep an accurate record of them.
Yeah, 100%. I think that's also probably in the retail space, what is most undervalued is research. A lot of people, especially just seeing stuff on YouTube, everyone really does believe it's just one strategy. You find one strategy that works out of the hundreds of strategies that don't, and that strategy is going to work until the end of time. You consistently execute on it, and that's it. That's your golden ticket in trading, and that's just not. It's the wrong thing to optimize for. You're never going to have one strategy that works forever. You may have one strategy that works really well during one particular period, like 2020, for example. But ultimately, the game of trading is research, especially if you're systematic around it. Obviously, if you're discretionary, then it's more of a game of like building up experience, intuition, I guess a bit of discipline as well, etc. But for systematic trading or more of a scientific approach, it's a lot of research. You just have to always be testing things. And I think one note you have here that I want to kind of touch on as well is many of my ideas are not original. And I sometimes see that people kind of have to think that their idea has to be unique. Like this simplistic idea just can't believe to be worked. It's too simple. Everyone would be trading it. While that is true in some cases, if something's too simple and it's not, let's say, a risk premium, for example, then yeah, it could definitely get arbitraged away. But a lot of simple ideas do still work. The key thing with them, and I kind of like the saying, I can't remember from what podcast I watched it from, but he was basically saying a lot of the simple strategies work because there's a lot of pain involved. And that's why inherently that they stay an edge, because they're very difficult to execute on. They're very difficult to maintain to. Like a classic example is trend following can go into drawdowns for years. That is not a fun experience. That is not an experience many people can hold through. But that's also why trend following can continue to work. So I don't know. At least for me, I've taken pretty much all of my ideas from probably someone else. I don't think I've rarely had like a completely unique idea. Do you do the same, Pedma? Are your strategy ideas unique, or have you kind of copied them from people as well?
No, everything I do is basically like copies and a little bit of my own touch, from what I see from other people and stuff like that. And yeah, you don't have to be unique. Like we were just talking about how you have to innovate to stay relevant in this game, but there's strategies, like you said, like trend following that show persistence in their extra returns over time, even though they decay. Like they are not the same they were in the 80s or something like that, but they do continue going forward. And that's because they are not the most attractive type of strategies, because they go through drawdowns for a long period of time. They are not the highest sharp, they are not the fanciest strategies. And you as a small retail investor can go there and take those strategies, apply them to newer markets or different markets with lower capacities and stuff like that, and run your own book with these ideas that are just taken, and you just run it in a way that professionals don't find them attractive from a risk perspective. And then you have a new idea, a good idea that works for decades, just spin it out in a different way. And that's how you can reuse different types of strategies in unique and, let's say, more different ways that make money for your own portfolio. And that's what it's all about, in my opinion. You are not going to invent a wheel here.
Yeah, 100%. I think this kind of leads perfectly into my second point, which is about, do you think conviction simply comes from testing? I was kind of talking with a couple of people on Twitter around it, and I wanted your opinion. Do you think conviction is just purely from testing, or is it from anything else?
It does in some part, but at the same time, if you never deployed a real model into the market, and not only did you make money from it, but you also extracted money to your bank account from it, like real, you don't have much confidence, right? It's like the same, oh, I'm going to start a coffee shop or something. You see other people succeed at it, but you don't have the confidence, even though you know that it can be successful because you have never done it. So I do think that testing, watching like an equity curve and doing your robustness analysis, or everything, if you've done it very well, it can help you get some confidence, but in my opinion, you will never get truly confident unless you have been running something for 6 months, 1 year, and you've seen real money from that activity. At least that's what happened for me.
I think that's quite true. I think a lot of people, I think it comes in two stages. Like for me right now, conviction kind of purely just comes from testing. I don't really have that kind of nerves of like deploying a strategy. But when you're deploying maybe your first strategy, whether it be automated or manual, there can be just initial nerves. It's a new thing. It's a kind of a new experience you're doing. You're trying to see if it actually works. So yeah, I definitely think seeing some live results then kind of builds up your conviction. And then over time, you can kind of move that conviction to a lot of just, does the data make sense, or does this inefficiency make sense from your experience? So like a couple of the trades we've taken recently, they didn't have that much data behind them, but we logically understood the inefficiency behind them, and that gave us a lot of conviction. I didn't really have to think, I don't have too much conviction in this particular trade because whatever reason, I just knew the data or the inefficiency behind it, and we took advantage of it, or we at least tried to. So I think a lot of it, in my opinion, in the second stage, after you've got through those initial jumps, it just comes from testing. And that's why I think backtesting and just general testing and understanding inefficiencies in general is the key to following your system. I think there's an amazing systematic trader. I think her name is Sunny J. Harris. And I was listening to a podcast recently, and she was saying that if you are simply not following your system, it's probably because you haven't tested it enough. While obviously that's a bit oversimplified, I do think fundamentally that stays true. If you understand your system well enough and you have tested it well enough, you ultimately should just be able to follow your system, because it would seem illogical not to. And that's kind of how it is nowadays for me. Like if I'm seeing an algo take a trade, I'm not questioning, hey, that trade isn't near a support or resistance line. I'm just saying I already know the system works. I've backtested it very well. I've seen some live results as well, and I'm just having pure conviction in it.
Yeah, exactly. I think that the most important, if you can like get a step back and really define what's the most important behind confidence, and to me that will be around my intuition, and that comes from experience. I'm not saying intuition on trading, like trading discretionary. I'm saying intuition about markets, what I know that drive markets and stuff like that. The intuition that involves experience, and then a strong fundamental understanding of that what I just said, like what drives markets and stuff like that. And then, but that all comes with experience, so it's hard to say to the listener what is that. And then comes the testing after that. For example, if you told me right now, Kedma, you have to we will trade for the next 5 years like an RSI breakout above the 70 and below the 30 for like above the 70 for a buy and below the 30 for a sell on equities on the weekly time frame. I'll tell you right now that will probably make money if you run a diversified book of equities. I know that equities have strong momentum behind them, and that is a momentum strategy that should work given those parameters. And I don't even have to go to a backtest to understand that, because I know that is something that drives that type of market. So it all comes down to your own experience and what you observe in the market, and then the testing adds that layer of confirmation that you need.
While I agree, I think I would fight back on that. That is the main cause of like conviction. The reason behind that is when you break down what you said, like that particular strategy example, you know that would work because you've seen already a lot of data around surrounding things of it. No.
To be honest, I haven't tested that strategy on equities ever. I just know that it is like a momentum signal, and if there's strong momentum in equities, which you can find their momentum, or in cryptocurrencies, you know that that should do well. If there was no momentum in that market, I would say that the strategy wouldn't work there. But you have to confirm it with the data.
That's interesting. Like, at least from what you were saying, is like I think the same way. I can look at a lot of strategies nowadays, and I'm like, I kind of have an idea if that would probably work or not. But that's only because I've already looked at so many different sort of general strategies and a lot of different data where I can make a better assumption than most about that particular strategy idea, right? It wouldn't necessarily like if you'd plot me back to the first year, my intuition and experience with this would be terrible, right? Like I'd be
Yeah.
picking the worst strategies ever. So ultimately a lot of it for me at least came from testing first, and then obviously over time from seeing so many strategies from testing a lot of different things, you kind of get that intuition, as you're saying, of what one could work and what one doesn't. And also like a key thing I think both of us look at, right, is like, is there a key reason why that should work? Is there a fundamental kind of like not lore but fundamental either inefficiency or something you're exploiting of why that particular strategy would work? So like a momentum one, we know momentum works in most markets, and because as you're saying equity has momentum for the most part, you can take advantage of it. Well, is it going to be buy and hold? That's a thing where you'd actually have to test, because would you have conviction that that particular momentum strategy of RSI is going to be on equities? You don't 100% know.
On equities,
Yeah.
I think that if you go high enough on the time frame, there's very strong evidence that you can find there a lot of momentum. There's a lot of research and stuff like that. So I would say with some confidence that that strategy should work in equities. Yes, the higher the time frame that you go. I'm not saying that you go on 5 minutes and plot an RSI, right? I'm saying weekly even.
Yeah, no, but I'm saying that like for you to know if it beats buy and hold, that's part where you'd have to test it. You could have an
Oh,
idea that it may work, but you wouldn't actually know if it outperforms.
Oh, exactly, exactly.
Yeah.
I'm saying that, yeah, exactly. That's a very good point. Because that's a whole different conversation now. Now, what we were talking about is putting some strategy that you know works, and defining what works is where then the debate starts from a like a researcher perspective. Because okay, it can have that simple RSI strategy that makes you money, but maybe it stays below a simple buy and hold,
Yeah.
but allows you to not be exposed to certain risks in equities that you are not comfortable with. That a buy and hold is like when you buy and hold, you are like exposed to country risk. Yeah, buy and hold of the S&P 500 has been great for the past 100 years and plus, but will it go be the same forward? That's a bet you are making on America fundamentally, and those are
Mm.
conversations that I'm not comfortable with. So I stick to systems. And yes, then, for example, on that RSI system that I just said, okay, now you would go and you see, okay, what's the alpha that you generated here above a simple beta of the S&P 500? And then those are different conversations.
Yeah, 100%. I think also a lot of this comes down to I wrote this kind of sentence on Twitter recently, and I was surprised that people agreed with it as much. It was just a sentence that stuck out to me from the past kind of year. I simply said, most people prefer to think if they are right or wrong rather than find out. And I think a lot of testing, at least from the experience I've had with talking with people, a lot of people kind of, politely said, kind of hide away from testing the strategy, from testing if it actually works, because it's kind of a nicer experience to think, well, this could work. Hey, like, maybe after 100 trades, this could maybe have like an edge. And that's, I think, there's a big difference between discretionary and systematic there, is that I always prefer to have an idea, does this actually be buy and hold, at least historically, or does this actually provide me some sort of evidence of why I should be trading it? But it's a very small note, but I think generally, would you agree or no?
Yeah, definitely. I think that people, it's like buying a lottery ticket, right? Everyone knows that they'll lose
Exactly.
money, but they still want it,
Yeah.
because it's risky. I read in a book, a trading book as well. I don't remember which, but it's like that guy that comes that he has his own work like during the day, even he's successful at it, but he comes home at the end of the day or whatever during the day, and he starts betting on stocks, on individual stocks. And even though he knows that he doesn't make money with it, he likes to feel that rush, to feel that. And then the trading is this. How can I say? You can make it look professional, you know. You tell people you trade stocks, you invest in stuff. It's not like going into a casino and being a gambler. That's degenerate. Like you're going to get criticized by your family. But if you tell them, "Oh, I'm investing because based on these fundamentals and that," so it gives that gambling. How can I say it? That aptitude for risk, like a meaning. And I think that a lot of people fall into that because you want to feel important, but at the same time you don't want to truly test your strategy because it might break your own false beliefs.
Yeah, I completely agree. Like breaking beliefs as a human is one of the hardest things, especially that comes into trading as well, as like going against what you traditionally would think. And it takes a long time to be able to get comfortable breaking your beliefs very quickly. And that's also one thing I always look on Twitter is if I see a very successful trader not be sort of open to new ideas or things like that, I'm always a bit wary of it because we're both the same. We've had a lot of new ideas come across, and I'm always trying to be open and think, well, hey, that could maybe work. You know, you don't want to be so solidified in your roots because that just becomes dangerous ultimately if you can't change your beliefs.
Oh yeah, I've wasted many years of my trading career, let's say, being arrogant. That's funny because I wrote about it today. I was very arrogant in the start when I was learning because I thought that there was only one way and I knew it. I didn't even have a Twitter account for most of my when I was learning, which was stupid because I should be like exposed to new ideas and frequent new ideas. And I was not because I thought this is the only way to trade and this is the only way, blah, blah, blah. And no, you have to keep an open mind and remain humble and ask people that are ahead of you what they are doing and stuff like that.
Yeah, 100%. To shift on to my last topic, it's an interesting question. I don't think it's too serious of a question, but I've been very lucky enough to talk to older traders and then also younger traders. And I wanted your opinion. Do you think trading is a young man's game or like an older man's game? What one do you think has more benefits?
Man, uh, that's a good question. It depends.
I can share mine first if you want to think
Yeah,
about it.
please, please.
Sure. All right. Personally, I think learning to trade, the young man takes the win there because you have less dependence. There's less catastrophic things that can happen from you losing money. You have a lot of time to make it up. You can always get back into a 9 to 5 or a career when you're younger. Most of the time, as well, when you're younger, you could be doing this whether you're at your parents' house, if you're that lucky, or you could be doing during uni, all those sort of things, right? You could be working a part time job. No one looks really down on you if you're a young person working at a Starbucks or things like that. There's not as much ego attached, right? So I think learning, it's definitely a younger man's game, but that's not always true. But I would say for actually gaining success and gaining momentum and actually P&Ls that matter, it's definitely an older man's game in that case. Like I think my biggest P&Ls will be when I'm 50, and that's obviously because of compounding, obviously, but also it's down to that you can have a lot more spare capital and a lot more time behind you of where you've accumulated capital. Whereas a 20-year-old, it's very impressive if you can meet a 20-year-old that has 25K to make a PDT account, right? Like that's not exactly a very common thing, and it's very actually hard to do, especially when you're that young, unless you've been working throughout the teenage years. So I think for max results, it's an older man games. For learning, I would say it's like a younger man's game. And I also think, at least for me, that's how I've looked at trading, is that I didn't mind losing quite a lot when I was younger because I didn't even see it really as a negative if I learned trading and then went back to a 9 to 5 and kind of kept on trading on the side. I don't think I ever saw a future where I wasn't trading at all, or at least doing something around trading. Obviously, I'm very lucky now that I basically trade full time. But when I was planning it out, I really didn't mind if I was working an accountant job and then I was coming home and still managing some portfolio or whatever, just because then I could have those skills for my later years where it really, hits if you're compounding and investing consistently.
Uh, I couldn't have said better. I I think that's really I think that's really the answer. It's like learning. I don't want to discourage anyone, right?
Mm.
Uh, because I've seen some cases where people start learning late and they learn it and they are more controlled. Because even when you are younger, at least I talk for myself, I had a very big appetite for risk, and that hurt me a lot. And that's something that happens when you are younger, right?
Yeah.
you want to conquer everything tomorrow, and that can hurt you. And so if you are a bit more experienced and you have a more capacity for logic thinking and stuff like that, maybe being older will help. But I speak for myself. Looking back, it was very helpful that I didn't have to pay bills. I didn't have a lot of responsibilities and stuff like that, and I could just gamble it all away on this one dream.
Yeah.
And yeah, I fully agree. I think it's easier to learn in your 20s, but at the same time, I don't want to discourage anyone. If people are set on this path and they are not in their 20s, whatever, try it, whatever. We just have this one life, right?
Yeah, 100%. It's definitely not a conversation saying that it's impossible if you're older. I think there's, pros as well when you're older. As you were saying, like, I remember one psychologist podcast I was watching ages ago. I don't know why this has stuck with me for such a long time, but they were saying, when you're younger, you have more testosterone. So you're more willing, as you're kind of saying, to take kind of dumb risks, if that makes sense. Whereas when you're older, you can be a bit more wiser. You can be a bit less arrogant about your positions, a bit less arrogant about how you trade, all those sort of things. So those are obviously advantages that come with it as well. And then obviously, if you're starting to trade when you're older, you have more capital probably at your disposal. Yeah. I will say, as an ending note on that particular conversation, the people I admire the most are people that somehow became profitable while having kids. That is just crazy feat of how many challenges I must expect you to run into. Like, especially when I talk to traders that have had kids and trading profitably at the same time, just huge respect to them. I can't even imagine how kind of difficult that is.
For sure, and the job, like,
yeah.
I don't even know how you do it. I had a job. I went to, like, I was, my old boss won't hear this. So I was going to my office and like trading from the office. Like I had a little office. I would close the door, close the drape, and I would close everything, and I would like be there trading the open candles when I was still trading manually. So, and it was hard because people were always interrupting. You had your responsibilities at your job. So I really respect anyone that tries to do any kind of business, not just trading, any kind of business besides their work and family responsibilities and stuff like that.
100%. Just because you gave one small story, one story came to mind straight away for me was that back in university, I remember I think it was an exam, but for whatever reason in my university, you could have your phone in your pocket. Obviously, it had to be like turned off, but they never really checked. And I had a trade open at the same time as the exam, and I had to go to a bathroom and close it. And I realized I'd lost I think at the time it was like $200 or something, but that was a decent amount of money for me. So I remember coming back into the exam hall just furious. I was so mad that it taken a stop loss on it, but it's those things you have to do when you're kind of learning. There's a lot of just crazy janky solutions of what you're doing while learning.
It's like when I remember being at my desk and like, I don't know, I made $700 or something that day. It was something like that. Was when I was about to quit my job. I was like, nobody talks to me right now. I made $700 today.
they don't know how amazing you are. $700 in like an hour or something. It'd be crazy.
I was looking around and saying they don't know I'm paid, man.
All right. Well, you've got some amazing topics here, so feel free to jump into any one of those.
Yeah. So for the listeners that like a little bit more of a practical trade, like today, I went into a rabbit hole. We were talking a bit off the podcast before. I saw this new protocol, new project on Hyper EVM, like on Hyperliquid chain, and it was like almost like a binary option type of situation. Like you have an expiry date. You have like if it expires above a certain price, you get paid whatever 17%. Or if it's very close, like if it's very low odds, you get like 300 or 400% payout. If you get like below, if it's very high odds that will happen, you get like very little payout. A standard like binary option type situation. And I was like, okay, this is interesting. It's new. Probably should be there here some inefficiency. So I started looking around. I began going into poly market because if you have someone like a betting market on one side and you have another betting market on the other side, I tried to see if there was some mispricing of the options there. And I was like, and then I started reading the documentation. I noticed that no, actually this platform is pegged to poly markets like odds. So it was almost the same, and I already had to put a trade on because I made some miscalculation on my math here, but I only had to put like $1,000 in. And so and then I was like, I had already like a plan. I was making a $300 or $400 a day. I was going to keep it very small so that the exchange wouldn't notice me and start extracting money every day. But yeah, that went down the drain. Then I spent the entire afternoon like trying to find a hedge to this, because now if this expires, like it is a BTC option trade, if it expires above 86,000, I lose $1,000. So I had to hedge it somewhere else, but it's kind of tricky. And it's one of those things that you sink a bunch of time going through the math, going through the documentation and the code. And at the end of the day, it wasn't worth it because I didn't find any mispricing. But other times, this stuff happens, like we were talking about before, like exploring new ideas, and you find something that you can really capitalize on. And you have to go, though. There are days that you send down the drain, and that's the nature of this business, I guess.
Yeah, 100%. It's a lot of like, at least in this particular context of like pure inefficiencies or arbitrages, a lot of times it's a lot of small bets that you have to do the maths afterwards, basically. Because
Yeah.
if you spend all the time doing the maths before, then you never know if the inefficiency is gone by then. So I think, at least for both of us, we normally take on a smaller position first, see if it actually works out, if it makes sense, and then we can add to it more if it doesn't. If it does, sorry. And then if it doesn't, as you kind of do, you either hedge it or you just fully get out. But it's a very interesting arb if it was true.
Yeah, yeah. It was very interesting. It said that everything seems to be so far like really well priced in. I even went into the perpetual options market here and see if I could find something, if I could find a way to get my position in, completely edge out the risk and try to extract a little bit of edge. But I found one, but it only paid like 20 or 30 bucks. And I was like, for all this work to get paid 20 or 30 bucks, it's not worth it. So I didn't do that, and that's it.
Yeah, that makes sense. Hey, 20, $30 could be your lunch or something, but yeah, I agree. If you're putting in, a solid amount of time, you need a solid ROI on it. Otherwise, it's not really worth it, especially at your stage.
Exactly. It's like I'm not. Yeah. The only thing that it's good here is that these platforms are offering points, because it's in crypto, when you have new protocols, new exchanges, stuff like that, they run programs to incentivize volume and usage, and it usually can get airdrops. So that's also good incentive to try something around it. But I don't want to spend too much time on it. And
No, it's fair.
yeah, when you are doing research and trying new ideas, new different ideas, you have to always be more efficient with how you do stuff. Discard things quickly and move on to new ideas, because there's so much that you can do, so much that you can look at, and there's just so many hours in the day, right? So
Yeah. One question I actually get asked a lot, and I never really know how to answer it, is that what percentage do you think of your ideas don't work? Like strategy ideas?
that's a good. Uh,
Because normally when I responded with it, I normally say like, in the start, I think it was a lot of them. Like I think a lot of my strategy ideas didn't work outside of small caps, because small caps was just a very obvious edge. So outside of that, I think when I first got into futures, oh man, it was maybe 80%, 70% of my ideas didn't work. And it was because I was trying to do stupid things like 1 minute time frame, 2 minute time frame sort of things, that just didn't make any sense. So at that time, I think it was a high percentage. And nowadays, it sounds cocky, but I feel like maybe 60%, 70% of my strategies probably work, but that's because they're very heavy filtered. Like I don't try strategies. I'm pretty confident that they won't work, if that makes sense.
yeah, that makes sense. I couldn't tell you, to be honest with you. Like deployed strategies, I yeah, probably I should, if I could make a guess, is around that. Probably 70-80% of my ideas don't work. Uh, but it's not like, okay, but it's different, right? If I organize them into into buckets like risk premia or stuff like that, known effects, like
Yeah.
those are higher hit ratio, so I know that I'm going to be right on most of those. But in terms of these weird inefficiencies that I try to find over time, these are much lower hit rate, and I'm wrong a lot.
Yeah, 100.
Like the next topic that I want to talk about is like around how to run a portfolio of strategies, because I got that question recently. And my idea is, if I had to go back and tell myself like, okay, this is how you're going to trade, I would tell him that, like, first you run a simple book of like of risk premium. For example, even simple stuff like buy and hold. You buy and hold like equities, gold, whatever. I'm not giving you investment advice. Of course, I'm just giving an example, an hypothetical example, and I would be running like something like equities, bonds, gold, Bitcoin, crypto, stuff like that, like into a mix. And I would be looking at their volatilities, rebalancing them regularly to keep everything matching target volatility, like keeping everything running very how can I say, very robustly with the market. Okay, everything rebalanced, giving proper weights, everything like a very mechanical thing. But it's very simple. It's just a buy and hold, right? You're just rebalancing every month or every 2 weeks, whatever. Because if the world economy continues to grow, you grow with it, so you don't risk losing all of your capital in your trading. And I would allocate most of my trading capital to that idea. Then I would go to branch out to a same risk premium, can be considered risk premium, like a simple trend following strategy or something like that, and apply that. That requires a bit more of my input. I have to execute more, manage a lot of positions, but that's another good layer of strategies that I would add on. And then only when that base is covered, so your base of known effects that should continue to work into the future, because it has a long history of working out, then I would branch out to more speculative ideas. And then I would branch out to stuff like whatever interests you, right? Small caps, micro caps, cryptocurrencies, DeFi, whatever interests you. But I would first establish sound ideas, and I would not gamble all my capital in ideas that I don't know will work or are very high risk and that I could blow up my accounts, so that I could always come back and continue going and have something solid running on the back end. What do you think, Manir?
I think you kind of put it perfectly. I do think it depends on where the person's starting from. I always try and ask people if I'm ever working with them of like, are you working from a place of that you have a strategy that currently works, like has done solid returns for X amount of time, or are you coming from a place that no strategy of yours kind of works right now and you're kind of like fresh book basically, you're creating a fresh portfolio. Because if you already have one strategy that's working, then I would just say try and do a low correlation or uncorrelated another strategy to it, and that's probably going to provide you the most benefits. Now that obviously could be a risk premium, but it just depends on what the person's running. But if I was creating a fresh book, it'd be basically exactly how you described it. It doesn't have to necessarily be in crypto. You can do it in futures as well. Just if you're doing futures, it's probably going to be more like me, where my futures is basically just risk premiums. There's not many like pure inefficiencies, and then my more pure inefficiencies, or as you're kind of saying, like short-lived inefficiencies, are coming from crypto nowadays, or in equities if it's like small caps or a parabolic play in small caps, things like that. And then you can make some kind of I'm not going to say quick money, but you get what I mean. It's a faster-lived edge.
Exactly, and it's a very much high risk edge, like we talked
Yeah.
about. It's like you can blow up. So better to have something solid that professionals run, and it's professional and you can maintain, and it takes work and takes your own intuition to the next level, because you are learning about market dynamics, about executing costs, everything like that. It's really important. It's boring strategies, of course. And then if you get really good at really, let's say that you get really good at shorting microcaps, then you can run that strategy to capacity on your own, and do that. But don't bet all your eggs on that type of strategy, is my own opinion. That's what I would do. I might be wrong.
Yeah, no, I completely agree. I would say like it's kind of like how we have it, that we have our core strategies, and then most of the time, if we take a trade together or an idea together, we're taking it from a small percentage of our portfolio, whether that be, I don't know, 5, 10K, whatever, that we're taking on that higher risk trade, where I know I could probably lose that full 10K if I deploy it. But I'm fine with that, because ultimately that isn't going to move the needle too much, but it's also a decent amount of risk to put on, where if the trade works out, obviously because it's something that we believe in, then it's a good inefficiency to exploit.
I completely agree.
All right, perfect. I think that kind of sums up this week.